Hey guys, today we're going to learn about the Federal Reserve System and all the tools it has to stabilize the economy and the financial markets. First, we're going to learn about the economic concept underpinning the Federal Reserve System. Then, we're going to go over all the tools that it has at its disposal, one by one. We're going to explain in simple language what each tool does, so that by the end of this video, you'll know exactly what the Fed is doing the next time you read about them in the news. And lastly, we'll compare and contrast the Fed's efforts during the 2008 financial crisis with their actions during the 2020 coronavirus crisis. For those of you who are counting on the Fed to save the stock market from future crashes, you're in for a major surprise. If you like this video, please share it with your friends. It'll really help our channel grow faster. First, let's establish how the economy works. The size of a country's economy is measured by gross domestic product, or GDP, which is the value of all the goods and services produced in a country within a specific period. The United States is the world's largest economy, with a GDP of $21 trillion in 2019. This means that from January 1st, 2019 to December 31st, 2019, the United States produced goods and services worth $21 trillion. GDP equals consumer spending plus business investments plus government spending plus net exports. The idea is that whenever you spend your money to buy something, like candies, cars, houses, there must be something that was produced. So if you add up the sum of all the money spent by individual consumers, businesses, and government institutions, and then adjust that by the value of items sold to and imported from other countries, that will give you the value of all the goods and services produced by the country. When GDP increases, we're in a period of economic expansion. When GDP decreases, we're in a period of economic recession. Every now and then, something bad happens, such as the financial crisis and the coronavirus, and causes economic recessions. To stabilize their economies, governments have two types of actions available. They are known as fiscal policy and monetary policy. Fiscal policy attempts to influence the economy through government spending and tax rates. Recall that the GDP is a function of consumer spending plus business investments plus government spending plus net exports. When the government spends money, like building airports, building highways, or buying food, these expenditures boost economic activity and add to the GDP. And by changing tax rates, the government can influence consumer spending and business investments. When people and organizations pay less taxes, they'll have more money to spend, thereby driving up consumer spending and business investments, which increases GDP. So fiscal policy is implemented through changes in government spending and tax rates. In the United States, fiscal policy is managed by the Congress and the White House. So when the government sends stimulus checks to people, that's fiscal policy at work. Monetary policy, which is arguably much more powerful than fiscal policy, attempts to influence the economy by controlling the availability of money in the economy. Through monetary policy, governments can influence how much money people can access. The availability of money in the economy is known as money supply. That sounds very abstract, so let's look at some real-life examples that you can relate to. If you have bank accounts, you'll notice that pretty much all the banks have all these limitations on daily or monthly cash withdrawals. You may also notice that sometimes it's very difficult to borrow money from the banks, and sometimes it's very easy. Like right now during the coronavirus crisis, it's very difficult to borrow money. These are some examples of how the government controls the availability of money in the economy. It can relax the rules so you can withdraw greater amounts of cash with unlimited number of transfers and make it super easy to borrow money. Or it can tighten the rules to make it much more difficult for you to spend. Said differently, monetary policy controls your ability to access money, be it hard currencies in the form of dollar bills and coins, or the number you see in your online banking account. In the United States, monetary policy is managed by the Federal Reserve. The Fed acts as the central bank of the United States by setting the rules for all the regular banks and overseeing the availability of money in the country. If your bank limits the maximum number of transfers you can make each month, that's because the Fed said so. The Fed does not report to the White House or the Congress, so not even the president or the congressional leaders can tell the Fed what to do. This was designed on purpose so that the Fed can act in the best interest of the economy, independent of politics. There's always demand to use money. Consumers use money to buy things. Businesses use money to pay employees, pay suppliers, etc. Governments use money to maintain military, pay police, and so forth. The supply of money in the economy relative to the demand to use money in the economy at any given time not only affects ease of accessing money, it also influences the interest rate. When the supply of any item increases relative to demand, the price of that item decreases. It's the same concept when it comes to money. When the Fed increases the supply of money relative to demand, the money supply line shifts to the right and the interest rate decreases. So not only does it become easier for consumers and businesses to access money, but with a lower interest rate, consumers and businesses earn less money from the money they have deposited in their banks. And with more money available at a lower interest rate, it becomes easier and cheaper to borrow debt, whether that's credit cards, mortgage, car loans, or student loans. All of these encourages people to spend money. Therefore, by increasing the supply of money in the economy, it becomes easier to access money. Interest rate is reduced, and this encourages consumer, business, and government spending, which increases GDP. By contrast, when the Fed decreases the supply of money in the economy, interest rate increases. With a higher interest rate, consumers, businesses, and governments can earn higher interest by depositing their cash with their banks. It becomes relatively more attractive to save cash instead of spending it. It also becomes harder and more expensive to borrow money, so they spend less. A lower level of consumer, business, and government spending translates to a lower GDP. This is the big idea behind the Federal Reserve. Its mandate is to control the supply of money in the country, which affects spending patterns, which affects GDP. That's the economic concept underlying the Federal Reserve. All the tools that the Federal Reserve has revolves around this concept of monetary policy. By the way, we have many more videos on our website. If you want to learn more about finance and investing, check it out. So what are the different tools it has to control the availability of money in the economy? Here's a list of all the tools the Fed has in its arsenal to increase or decrease the money supply. Let's go through the list one by one. All of these tools have bizarre names, using a whole bunch of jargons. But don't worry, we'll break each one down for you in the simplest terms possible, so it becomes easy to understand. Broadly speaking, the Fed's monetary tools can be categorized into two types: directly changing the interest rate and changing the money supply, also known as quantitative easing. Now, there are hundreds of different interest rates. Every bank and every type of debt will have different interest rates. So what interest rate exactly is the Fed changing? It changes two interest rates: the federal funds rate, or FFR for short, and the discount rate. The federal funds rate is the interest rate that banks pay to borrow money from other banks. The discount rate is the interest rate that banks pay to borrow money from the Federal Reserve. Banks typically only want to borrow money from the Fed as a last resort, so they usually borrow money from other banks. As a result, FFR is usually the interest rate that news articles are referring to when they say the Fed decreases or increases the interest rate. Because the FFR and the discount rate determine how much it costs for the banks themselves to borrow money, they influence all these other interest rates that banks charge consumers and businesses. When the Fed cuts these two interest rates, it becomes cheaper for banks to borrow money from other banks. Because it's cheaper for the banks to borrow, the banks can reduce interest rates for businesses and consumers as well. This is arguably the Fed's most powerful weapon. The Fed relied on reducing FFR and discount rate heavily during the 2008 financial crisis to stimulate the economy. The rest of the Fed's tools revolve around adding or subtracting money supply from the economy, literally controlling the amount of US dollars in the economy. The biggest weapon the Fed has to do that is the open market operations. Now, technically, FFR is a part of open market operations, but we're separating them here to make things easier to understand. Open market operations is a program where the Fed buys treasuries from the banks. Treasuries are basically bonds, except they're issued by the government instead of by companies. When the Fed buys these treasuries from the banks, it's giving money to the banks and receiving the treasuries in return. As a result, the economy has less treasuries and more money. This increases the money supply. Next is the discount window. As the central bank, the Fed acts as the bank to all the other banks, like Citibank, Chase Bank, Bank of America, or Wells Fargo. When these regular banks need to borrow money, they can borrow money from other banks at the federal funds rate, or they can borrow it from the Fed at the discount rate. This ability to borrow money from the Fed is known as the discount window. You can think of it as the banks going up to the window, where the bank clerks sit behind, and ask to borrow money at the discounted interest rate, hence the name discount window. When the Fed lends money to the banks through the discount window, the banks receive money from the Fed, which they can lend to consumers and businesses, which increases money supply. Regular banks make money on the differential between the interest they pay customers on their deposits and the interest they earn from lending these deposits to other customers. When you deposit your money in the banks are required by the Fed to retain a portion of your deposit and only lend out the remainder. This percentage of customers' deposits the banks are required to hold on to is called the reserve requirement. By increasing the reserve requirement percentage, banks will have less money to lend to their customers. So you can have perfect credit score, but you won't be able to borrow debt because the banks might not have money to lend you. On the contrary, by decreasing the reserve requirement percentage, banks will have more money to lend, which increases money supply. The money held in reserve doesn't make money for the banks because they can't loan them out at higher interest rates. To compensate the banks for this opportunity cost, the Fed pays the banks an interest on required reserve balances. And if the banks hold on to the deposits beyond what's imposed by the reserve requirement, that's called excess reserve, and the Fed can pay the banks an interest on that as well. This is more of a tool to enable the Fed to effectively raise or reduce reserve requirements. The Overnight Reserve Repurchase Agreement Facility is a tool that allows the Fed to sell treasuries to the bank with a promise to buy them back the next day. So the Fed is giving the banks treasuries, and the banks are giving the Fed money. This reduces money supply in the economy. Through the Term Deposit Facility, the Fed allows banks to deposit money at the Fed, and the Fed will pay them interest. The money the banks deposit through the Term Deposit Facility does not count towards the reserve requirement, which means the banks will have to set aside additional money to meet the reserve requirement beyond however much they have in the Term Deposit Facility. This reduces money supply because banks will have less money to lend to the public. The Commercial Paper Funding Facility is the Fed's tool to buy commercial papers from eligible sellers. Commercial papers are short-term debt issued by companies that mature within 9 months. So when the Fed buys commercial papers from institutions, the Fed receives the commercial papers and money is given to the sellers. Commercial papers are removed from the economy and money supply is added. This increases money supply. The Primary Dealer Credit Facility allows the Fed to lend money to primary dealers overnight. Primary dealers can include banks as well as securities brokers. Through the Money Market Mutual Fund Liquidity Facility, the Fed makes loans to financial institutions, and these loans will be secured by assets purchased from money market mutual funds. In the United States, a lot of people invested their wealth in money market mutual funds. Normally, financial institutions have no problem meeting redemption requests when the people want to take their money out. However, during times of crisis, redemption requests increase, and financial institutions run into trouble meeting the redemption request. To save these financial institutions, the Fed makes loans to these financial institutions using the assets from the mutual funds as a collateral. This increases money supply and allows institutions to meet their redemption request. The Primary Market Corporate Credit Facility is a new tool established in March 2020 in response to the challenges created by the coronavirus. Because of the economic shutdown, businesses across the country had to shut down. They couldn't generate revenue, but they still had to keep paying expenses. In order to stay afloat, they need to borrow debt so they can have enough money to pay for all the expenses. However, when you have millions of businesses all borrowing at the same time, the regular banks don't have enough money to lend to everyone. This is where the Primary Market Corporate Credit Facility comes in. Through this program, the Fed will lend money directly to companies. So the Fed will be either the sole investor or one of many investors in the debt tranche of eligible companies. This increases money supply, and this tool alone was able to save many businesses from going bankrupt. It has a sister program known as the Secondary Market Corporate Credit Facility. This program is also newly established in March 2020 in response to the coronavirus crisis. The Open Market Operations Program allows the Fed to use money to buy federal government's bonds. This program allows the Fed to buy big corporations' publicly traded bonds. This makes the bond market liquid because investors know that there's the Fed out there buying and selling the same corporate bonds they're looking to buy or sell. When the Fed buys these large companies' bonds, The Fed is giving money to the sellers, and that increases money supply. Government treasuries and big corporation bonds make up a big piece of the credit market. But they're not the only types of debt we have in the country. For small businesses and for us regular people, we also have auto loans, student loans, credit card debt, equipment loans, floor plan loans, etc. These loans provide much needed money to small businesses and to us regular people. To make sure financial institutions can continue providing these types of loans to people who need them, the Fed has the Term Asset-Backed Securities Loan Facility. Under this program, the Fed will loan money to the financial institutions that hold these types of debt based on the value of the debt they hold. By lending money to them, the Fed is increasing the money supply so these financial institutions can keep extending these types of loans to us little folks. The Fed also supports small businesses through the Main Street Lending Program. Under this program, the regular banks can extend loans to small businesses, and then the Fed will buy 95% of the loans from the banks. So, for example, suppose Bank of America only has $1 million left that it can lend to its customers, and it lends this last million to a small business. Without the Main Street Lending Program, that $1 million is all the money Bank of America will be able to lend. However, with this program, the Federal Reserve will pay Bank of America $950,000 in cash to take over 95% of the loan. This way, Bank of America gets an extra $950,000 of cash that it can lend to other customers. When the small business repays the debt, 95% of the debt proceeds will go to the Fed and 5% to Bank of America. Businesses and consumers are not the only ones that need to borrow money. State and local governments also need to borrow money. Under the Municipal Liquidity Facility, the Fed will lend money to state and local governments. This way, the state and city and county level governments have enough money to keep things running. Beyond injecting money into the domestic market, the Federal Reserve also needs to make sure that those who need US dollar-denominated money overseas can access it. In times of crisis, there may not be sufficient money in the form of US dollars available to people and companies in other countries. To manage this, the Federal Reserve cooperates with other countries' monetary authorities through two programs. The first program is known as the Central Bank Liquidity Swaps, which is an arrangement with other countries' central banks, like the Central Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, and the Swiss National Bank. Let's use an example to see how currency swap lines work. Suppose the Fed wants to increase the availability of US dollars in the European Union so that European companies can access USD from their banks and buy things in USD. The Federal Reserve will give US dollar to the European Central Bank, also known as the ECB. The ECB gives the equivalent amount of money in the form of euro to the Federal Reserve. After the transaction, the ECB can then deliver the USD money to institutions in Europe. The two central banks agree to swap back these two quantities of their two currencies at a specific date in the future, which can be as early as the next day or as far ahead as 3 months, using the same exchange rate as in the first transaction. The second program is known as the Temporary Foreign and International Monetary Authorities Repo Facility. Under this program, other countries that maintain a bank account at the Federal Reserve can temporarily exchange their U.S. Treasury holdings with the Fed for U.S. dollars, which can then be made available to institutions in their jurisdictions. So other countries give the Fed whatever U.S. Treasuries they have, and the Fed gives them U.S. dollars. So that's an overview of all the tools the Fed has available to control the money supply in the economy. Notice that none of these tools allow the Fed to buy stocks. That's because the United States Congress never gave the Federal Reserve the power to buy stocks. The former chairwoman of the Fed believes the Congress should give the central bank the power to buy stocks, but it doesn't have the power yet. Lots of people have this mythical view of the Fed. They know it's really powerful, but they don't really know what exactly the Fed does. Now you know. So the next time you hear someone telling you the Fed will buy stocks in the stock market, you can tell them they're wrong. Of all the tools that the Fed has, buying stocks isn't one of them. While the Fed can't buy stocks directly, its actions do influence the stock market indirectly. That's because the Fed's monetary actions influence the economy, and the state of the economy will influence the stock market. Thank you to all of our fans who watched and shared our previous Did the Stock Market Bottom video. As promised, we combed through information over the last decade to put together a detailed analysis on the Fed's actions during the 2008 financial crisis and during the 2020 coronavirus crisis, so you can see how their actions stacked up against each other. Here's an annotated stock price chart showing the Fed's actions in 2008 between the stock market peak and bottom. Dark blue annotations are monetary policies implemented by the Fed. Light purple annotations represent fiscal policies taken by the White House and the Congress. And the orange ones represent major crisis milestones. We also made these charts available for download from our Lumovest website. Link is in the description. In the early days of the financial crisis, it wasn't immediately obvious about the economic challenges that lie ahead. From October 9, 2007 to May 9, 2008, what we call the first phase, the Fed started picking up signals that there's a heightened risk of a recession. It cut interest rates, but refrained from injecting money supply. The rationale is that while increasing money supply can help the economy if there's a recession, increasing money supply when the economy is normal will cause hyperinflation, which would make family savings worthless, and that'll be even worse than a recession. Businesses were still operating normally at the time, not like what we have now with the coronavirus situation, where businesses were forced to close. So the Fed took a more measured approach and cut interest rate instead of injecting massive amounts of money into the economy. But when Wachovia, Merrill Lynch, Lehman Brothers, and National City all started collapsing, it became very clear that the country has entered a major financial crisis. The Fed cut interest rates even further and activated many of its tools to increase money supply in the economy. By the way, notice how eerily similar the stock price movement is during the first phase of the 2008 financial crisis to what we have right now with the coronavirus when we put them side by side. The story with the coronavirus is a bit different. There weren't months of lead-up period to the main event like there was for the financial crisis. The lockdown shut down businesses happened in the matter of days, and so it became very obvious immediately that many businesses will fail if the Fed doesn't act. In other words, it may seem like the Fed acted fast during the coronavirus situation, but that's because the economic crisis came fast. The Fed implemented a ton of tools now, just like it implemented a ton of tools back when Lehman Brothers and other banks failed, when economic challenges became obvious. It's not like the Fed activated these tools in January or February in anticipation of the coronavirus crisis. So it's not definitive that Fed acted faster this time around if we look at the timing of the Fed's actions relative to when major crisis milestones occurred. Now let's look at how the Fed's actions during the two periods stack up with one another. The United States entered the financial crisis from a pretty stable economic environment. It entered the period with the federal funds rate at 4.75%. To stimulate the economy, Fed lowered it by 2.75% during the first phase and reduced it to 0% when the crisis became clear. The same cannot be said for the coronavirus situation. The United States entered the coronavirus crisis with interest rate already very low at 1.75% after just finishing a bruising trade war with China. The Fed had lowered interest rates during the trade war to stimulate the American economy. If you want to learn why the US entered the trade war with China, we have a video on the topic, and you can watch it here. To fight the coronavirus, the Federal Reserve cut the entire 1.75%, bringing interest rate to zero, just like it did during the 2008 financial crisis. But that's only a reduction of 1.75% relative to a reduction of 4.75% in 2008. Unless the Fed wants to push the United States into negative interest rate territory, it's pretty much out of ammunition with its interest rate weapons. Okay, so now we know how the Fed's actions compare on the interest rate front. What about the money supply? How much money has it injected into the economy? During the first phase of the 2008 crisis, the Fed only added in $2.3 billion. Again, that's because it's very risky to increase money supply if the economy isn't depressed, because it'll create hyperinflation. During the period when S&P went from peak to bottom, the Fed added slightly over $1 trillion, which pretty much the entire trillion being injected after it became clear the economy needed it as banks like Lehman and Merrill Lynch collapsed. But to fully pull the economy out of recession and steer it to the trajectory of growth, the Fed injected a total of $3.6 trillion through October 14th, when it announced that it'll end the quantitative easing programs. By comparison, during the 2020 coronavirus crisis, the Fed injected a staggering $2.4 trillion in the span of just 2 months. To put these absolute dollars in context, US had a GDP of $14.7 trillion in 2008. It declined by 2% in 2009 to $14.4 trillion, losing $300 billion. Divide the monetary stimulus by the GDP lost, and we get multiples of 3.3 times and 12 times. The United States in 2019 is a lot bigger than it was in 2008. It has a GDP of $21.4 trillion in 2019, and the economic effect of a shutdown is a lot more acute. If the economy declines just by 5%, then that's $1.1 trillion lost. Using the same range of 3.3 times to 12 times the 1.1 trillion estimated GDP the country will lose, the Fed might need to inject a total of $3.6 to $13.2 trillion this time around to support the economy. Now, these are rough numbers and not something you should rely on, but it does put things into perspective, showing that the current $2.4 trillion is good, but not nearly enough. The Fed will probably need to add more to the money supply. That creates a major problem. As we explained, the United States entered the coronavirus crisis already somewhat weakened from its trade fight with China. Not only was interest rate already low, which meant the Fed can only cut 1.75% instead of the much larger 4.75% it cut during 2008, but it's also sitting at record levels in terms of the assets it purchased through its money injection programs. Recall that the Fed adds money supply to the economy by buying securities so that the Fed holds the securities and money is given to whatever institutions that sold the securities to the Fed. The value of these securities that the Fed had bought as a percentage of GDP after trade war with China was already the same level as what the Fed needed to purchase to pull the United States out of the Great Depression. So it's entering coronavirus with interest rate already low and the same level of assets as the Great Depression era. Now, technically, the Fed can add an unlimited amount of money to the economy, which will increase its already record-high asset level even further. But that's an uncharted territory, and nobody knows how this will end. Maybe nothing will happen. Maybe adding record money to the economy and swelling the Fed's balance sheet to record levels will lead to decades of prosperity. Maybe it'll save the economy from crash in the short term, but cause chronic pain in the long term. We don't know. What do you think? And imagine if the United States re-enters a broadened financial confrontation with China during the coronavirus crisis. Thanks for watching this video, guys. We've been working on this YouTube channel really hard over the last 2 years, but YouTube isn't really good at promoting startup channels. So we're turning to you for help. If you like this video, please share it with at least one friend. It'll help us get more views and grow faster, which allows us to make more and even better videos for you. Thanks so much, and see you guys next time.